everyone for joining us today. So today is our final webinar for 2023. We've held quite a few this year. We've got some really good feedback. Today we have our special guest, Brett Smith from Vanguard, who was kind enough. He reached out to me to offer his time and services today. So Brett, thank you in advance for your time and from myself and our clients. Vanguard is synonymous with index investing, something we have covered off this year with our clients about our approach to investing. And we've obviously tilted towards more index investing this year. So Brett will cover off in more detail about what is index investing and the benefits of index investing over active management. In addition to today, we'll get an economic update on where Vanguard currently sees things in the economy, both domestically and overseas, and a bit of a future outlook on various topics. So today's webinar is being recorded, so a copy will be sent out to anyone to watch it later on. Just a quick general disclaimer, any information presented in this presentation is of general nature, so please seek professional advice before acting upon anything you see in this webinar. If you've got any questions, down below, right on the bottom of your screen, there should be a Q&A button. So type in your questions, and at the end, we'll come back and answer any questions that we sort of haven't covered off. So without further ado, I'd like to welcome Brett from Vanguard. And Brett, I'll hand it over to you.
Thank you, Lee. And look, firstly, I just want to say thank you to Aspiri Financial and to you, the clients of Aspiri, of just giving us the opportunity from Vanguard to speak to you today. We obviously thank you for your trust, support, and investment with us. And today, I'll probably speak to a few areas, as Lee has mentioned. I want to talk about, obviously, who is Vanguard. I want to look at the economic and investment outlook, and just talk to a couple of those key points or pillars that we talk about and have talked about for some time here at Vanguard. So with that, I might just jump in. And as I said, so I'm going to speak for about 30 to 40 minutes today. The presentation is going to cover, I'll start with looking at who is Vanguard, and then just delve into the economic and investment outlook, the current state, and then the outlook in the sort of 24-25 period. I then want to discuss Vanguard's investment principles, and these principles have essentially been consistent since our founding in 1975. From there, then want to look at this question or this topic that often comes up, which is this idea of index versus active investing. And then from there, we'll, as Lee mentioned, we're happy to take any questions. So please note down any questions as we go along through the presentation. So who is Vanguard? Look, just for me personally, I've been on board with this firm for almost 18 months now. And one of the things you learn as you come on board as a crew member with Vanguard is that it is a very large and global business, and we'll touch on that in a moment. But there is a lot of work that we do behind the scenes to make it look quite simple and straightforward on the surface. So we're going to dig into that a little bit today, and hopefully you've got some questions as we go along and start looking at some of those concepts. So a big part of Vanguard is essentially the values and the people. And so when you do come on board, as I mentioned with Vanguard, it is very much around this idea of value and this essential mission, I suppose. You hear that a lot at the firm. We talk about that with our clients. Is on the left of the screen there, you can see that. This is at the Vanguard story, and it really is true to this statement or this maxim, which is to take a fair stand for all investors, to treat them fairly, and to give them the best chance for investment success. On the screen there, you can see is our late founder, Jack Bogle. This is something that he truly believed in, and he essentially created a firm that exists for the investors. So this was a very different concept at the time in 1975 when he founded this firm, but it still stands true today that every decision we make is always coming back to this central mission of is this in the best interest of essentially our owners, which is the investors of our funds globally. Tim Buckley, you can see there on screen, is our current CEO. And the key facts that you can see on screen as well is we've basically got been around over 45 years now. We've got over 20,000 members of crew or people that work for Vanguard. We're in 18 locations globally, and our client base is almost twice the population of Australia when you think about it, 50 million plus people. So a lot of support, like yourselves, a lot of support, and a lot of trust, and that is always in the front of our minds with everything we do here at Vanguard.
Hey, Brett, sorry, could I just jump in there? Can you just touch on the point about who the owners are? You mentioned that the investors
Sure.
are the owners. That's quite different to a lot of other fund managers who are the shareholders, could be, on the stock market or private individual. Can you just explain that concept?
Sure. So basically, if we were sitting in the US today, and you were an investor in, say, a Vanguard ETF or managed fund, you essentially own or are an owner of Vanguard. So it's a mutual structure, and by that mutual structure means that everyone that is an investor is essentially treated the same. So the Australian business is essentially a subsidiary of that US business, and what it essentially means is that everyone that is an investor in Vanguard essentially is really my employer. So we don't have public shareholders. We don't have wealthy private families. We don't have a business that essentially is looking to maximize profits and essentially chase continual earnings, upgrades, for etc. So everything we do, we run the business at cost, and every decision we make, we basically have to clear a range of hurdles, including, is this going to be an enduring investment or decision? Is this in the best interests of our owners, our shareholders, essentially are the investors.
Thanks, Brett.
So I might then move forward to really, I suppose this is an interesting slide because this provides an interesting fact that doesn't always, I think, bear out, particularly in our Australian businesses, that we are actually quite a large investor in active management as well as indexing. So when we talk about indexing versus active, we're actually talking about it from the portfolio point of view, where we invest in both indexing funds and active funds where it makes sense, and we believe in what we call as more of a core satellite structure. So it's more about portfolio construction, but indexing, as you can see, is a very large part of our business, and that's really where the business was founded on, was this idea of tracking an index, of not essentially trying to time or markets or pick winners. It was really seen as, and has proven to be, the best chance of long-term investment success. And I'll touch on that on a few of those investment concepts later. But this essentially is what our business looks like today. You can see there that we have majority of our investments is through managed funds. We also obviously have a large portion of our money is invested in ETFs, and it's split there between shares, fixed income or bonds, money markets, and balanced investments as well. And as I said on the far right, you can see there's a large portion invested in index and also in active. So again, coming back to that central idea of acting in the best interests of our clients, when the firm was launched by Jack Bogle in 1975, there was this idea that investors' interests and essentially the managed fund interests weren't quite aligned. So we run what I mentioned earlier was a cost model, which means that as the scale of our firm increases, we can actually reduce the cost of investing for our clients. So as you can see on this chart, since 1975 when we were founded, as Vanguard has increased the scale, we've been able to reduce the cost of investing. And the result in the US today is that the average Vanguard fund is less than 1/5 of the cost of the average US mutual fund, and a mutual fund essentially is the same as saying a managed fund here in Australia. And this really was Jack Bogle's goal. He really wanted to reduce what he saw was far too high in terms of the cost of investing. And so we refer to this as the Vanguard effect. And you can see there that as we have reduced the cost of our funds over time, we've essentially dragged the market down to follow us. And that was really one of his essential goals that he thought once he saw that happening, that was success for him.
Brett, just a quick question there. The US has gone from 47 basis points down to 8 basis points, yet Australia's probably gone from 56 to 29. What's the big variation in between, the average fee a US investor pays compared to, say, an Australian investor?
I think that, well, firstly, I think the US business, as I said, has been around since 1975. It has had that longer term or longer tenor in compared to Australia. We have been operating here in Australia now for over 25 years. We like to see that, and we do expect to see that average fee come down. And we have started seeing in the last 2 years, in fact, that a lot of the more expensive, I suppose, active managers have started to reduce that fee. There is obviously also a larger, I suppose, investor pool in the US. It is a larger market, but I think as we go on, we will see more compression, or we will see these fees fall on average as we go on. So that is the expectation, and we continue to do that today with all of our investments.
Great, thanks.
So now I'm just going to turn to the current economic and investment market, and then we'll probably look at a bit of an outlook. I want to start with, suppose, this particular chart. And the reason why I put this on screen is, I suppose it's important to remember, when we look at markets, there are going to be periods where markets will be volatile. There are going to be periods where markets will fall, and there's going to be periods where markets will rise. But if you put it into context, suppose the markets themselves, we're looking at here, this is over 40 years of market returns, and you can see there essentially that, I guess, the short story here is on this particular chart is that most of the time markets are rising. So most of the time markets are going up. Yes, there are periods where it's going down, but over 40 years, you can see here that over 38 of those 40 years, the markets have actually been more what we call bullish than bearish. So it's been more positive than has been negative. So I guess that, again, it comes back to this tenet or this idea of staying invested, staying the course. And this was something, again, that Jack Bogle used to refer to, was whatever you do, whatever happens with markets is don't get out of the market. And I think, again, it's probably just worth bearing in mind periods where we do see markets fall. There's also we can also see quite fast recoveries. So this essentially has been the story, I suppose, of 2023. As we come into the year end, we saw this. More this excitement or this expectation on the back of everyone talking about this idea of robotics and AI, and it has been the theme for much of 2023, but it's only been the theme for a handful of stocks. And you can see on the slide here is that where we're looking at is in blue there, those blue dots is 2023 year to date, and the yellow dots was actually the year before, 2022. The orange dots in the center of the screen has essentially been they're looking back at really the last sort of 7 years and what you would see as an average return. What it essentially is saying is that very hard to pick what is happening in a particular sector or particular stock. It's also very difficult to predict what is going to happen in the future in the next 12 months. You can see on screen there, I've mentioned this idea of the Magnificent Seven. Again, it may be a term you've heard this throughout this year. And the Magnificent Seven essentially refers to a very small handful of stocks, many of which you're actually investing in or have exposure to through your Vanguard ETF, VGAD. Again, I'm sure Lee's mentioned that over the year, but this is what we tend to see in markets, is that very difficult to understand or to predict which stocks from year to year are going to outperform. But you tend to see that there is a handful of stocks which tend to control most of the return. And so this has been the story of 2023. Much of that started in October, late October 22. has started to lose some steam as we come into this fourth quarter. But it is a lot of this has been on the back of expected future earnings from companies. So you do tend to get this sometimes this strong movement, but over time it tends to be evaluated by the market on, are those earnings actually showing up that are predicted? And so very hard to predict from year to year which company is going to be the standout, but that's essentially that's been the story so far.
Yeah, I guess you could almost say that 2022's winners are now 2023's losers, and vice versa.
Exactly right. And you can see there that it's almost a straight line when you look at the 7-year performance. So depending on how you're looking at this, if you can see this robotics there, for example, on that far left of the chart, is you're looking at sort of 30 to 40% falls. Now, I don't know how many professional managers would have picked these positions or even held some of these individual companies when they saw these types of returns. I wouldn't say many did. But yeah, exactly right. So if we're looking at, we could be looking at 2024 and seeing, again, a very different story. But exactly right. Many of these losers, many of these stocks that would have been sold out or positions that would have been closed look like winners. But on an average basis over 7 years, they all perform pretty much almost in a straight line. Again, I've put this chart in the deck today because this is one that's obviously front of mind for many of us. There's been a lot of geopolitical risk, or a lot of these wars that have been happening. We talk about there on the most recently about what's happening in the Middle East with Israel and Palestine. But if we think back, it was probably 2 years ago or so now when the Russia-Ukraine situation started, and the tensions will occur. On the screen you can see many examples of different geopolitical tensions over time. They will occur and they will have impacts on markets. And what we've shown there essentially is what happens when these events occur in terms of the financial markets impact and then performance. And essentially the worry that geopolitical developments you typically think they may be significant drivers of asset returns. However, when you look across the events of the last 60 years, we find that share markets may react negatively in the initial news, that initial news story, or where the media is focusing their attention. But generally, these sell-offs are typically short-lived. So there is that general initial sell-off to bad news. But you can see there that generally it's typically short-lived. They tend to look through what is happening and look through to the other side. So we ran this analysis which evaluated the market reaction to 25 geopolitical events, and on average, US stocks had a 5% total return in the 6 months following the event, and an 8% total return in the 12 months after an event. So again, it's important to note that these figures represent averages of these geopolitical events, and they did take place in different market environments. So they shouldn't be, I guess, interpreted as guarantees of investment gains after these events, but rather meant to show that geopolitical events do occur, and they don't always condemn share markets to losses. So we've always believed in Vanguard are long-term investors. And we always believe that you shouldn't always listen to the noise that you hear out in the media, and that should focus on the things that you can control. So clear, appropriate investment goals, suitable asset allocation, and using broadly diversified managed funds or strategies, and really just trying to minimise cost as much as possible. So it is that, again, thinking about the long-term, your long-term goals and that long-term outlook.
I think that's quite important, Brett. There's always something to worry about, whether there's wars that are going on, or elections, etc. There's always something to worry about, and unfortunately, if you get caught up in that noise, right, and focus on what's happening today, markets are unfortunately they're looking ahead, probably 6 to 9 months ahead of what's actually happening today. So this is why you have markets generally not all the time, but most of the time disregard what's happening at this point in time. They're looking forward to what's going to be in 6 to 9 months ahead of time. And that's why that chart where you showed previously of, you know, the average market being up sort of on average 6 years, but it can be as long as 20 years. You know, this is why it's important just to ignore what's going on at the moment and just stay invested long term. So I think it's quite important.
Yeah, exactly right, Lee. We've touched on this earlier when I talked about this idea of this kind of, I guess, boom or run on the idea of AI. There's a lot of talk in what it will how it will change society or how companies are embracing it, and many are doing a lot of research into it today. But that's essentially the story of the chart on the left. Is you can see there that global equity markets were positive in those first 3 quarters of 2023 after those large losses in 2022. US, Europe, and global markets have performed best from an unhedged Australian dollar perspective. The valuations have been the biggest driver of returns globally, and the US and in Australia. And what I mean by valuations is really that chart on the right, which essentially is saying that in that kind of tan color you can see there on the chart, is that valuations is really talking about the values of the companies themselves. So what is the share price of those companies been doing? And so, as Lee mentioned, the share price of these companies, has been pricing in the idea of future earnings. So they've been very excited about what these companies can do. They've been pricing that in to the companies on a daily basis with those expected future earnings. And that's essentially how markets work. So they look forward; they're always forward-looking, and then later they will price in their expectations. So will earnings keep up with the market's expectations? And again, why it's very important to be diversified and to be invested in index funds as opposed to trying to pick those, those, as Lee mentioned, those winners or those losers from year to year. Currency I mentioned AUD, which is obviously Australian currency, and it played quite an outsized role in Europe's strong performance, and you can see that on the third column along. So the currency rates around European, euro to AUD at the moment, I think costs, we could probably, with $1 Australian dollar, buy something like around 60 euros, and we're probably not that far off the US as well when we think about those rates. So, so that's essentially been the story. We can see on the chart as we come into this sort of fourth quarter of 2023, that some of those markets and some of those returns are now just starting to roll over a little bit as we think about at the time of this kind of idea of rates pausing and then being on hold for longer. So what we're looking at the screen now is this is the chat. We talk about the Fed. You hear the news around central banks or what the Fed's doing or what the RBA is doing. And essentially, this is what we mean when we talk about central banks and interest rates. You can see there on chart that we're showing our projections there in the dotted line for fourth quarter and into 2024. And we've actually had some movements, or I should say non-movements, in the last month or so. It's been a very interesting time for bond markets. And we believe there that once the interest rates peak, we expect that the developed markets, and that when I say developed, I'm talking about obviously the UK, the US, I'm talking about Europe, Australia. We think that those developed markets where the central banks will take an extended pause, and they'll just wait to see more concrete evidence that inflation is actually returning to target. So what that actually means is they really do want to get back to that between that sort of below that 2% mark. And this implies that interest rates will remain higher for longer. We do believe at Vanguard, we do believe that rate cuts are likely, and we think they're most likely with the possibility in the second half of 2024. But again, this is going to be hinged critically on the success of actually taming that inflation. So this is our what we call, I guess, our dot plot. And you can see there those dotted lines represents where we think rates are headed into that second half of 2024. So at the moment, looks like we have paused, but again, it will be we are keeping an eye on those key indicators as to sort of tell us where do we think the central banks are headed. But at the moment, it looks like we're on pause, particularly the Fed. We don't think there's another rate hike in 2023. But again, we're watching that closely.
So just looking at that plot chart, you're kind of expecting Australia another 1 or 2 interest rate rises?
So this chart was produced in around September.
Yep.
And at the time, we did believe there was 1, possibly 2 rate hikes over the next 6 months. We've seen 1 rate hike since this data was produced.
Yep.
And here in Australia, we haven't seen that from the Fed. At this point, we would say that the Fed, there's still room possibly for both the Fed and the RBA to raise 1 more time, we think, before they pause. But we're basically keeping an eye on those key indicators. So we'll be looking at what happens with wage growth. We'll be looking at the unemployment number, and we've been doing that throughout the year. So we think that we're possibly at the top of this current interest rate cycle, but we're not ruling out the idea that there may be one more move. So again, we'll basically be watching the data. But inflation has been falling. It is falling towards target. We think though that target may be slightly higher than where the Fed thinks it should be at the moment. But they've been very clear, the central banks, and they want to get that inflation rate, back to 2%.
Does Vanguard have an opinion, I guess, on future inflation? Like, is it going to be, not get back to maybe that 2 to 3, it might be like 3 to 4 or anything like that? Is that?
Yes, we've been talking a little while in probably the last 12 to 18 months about this idea of the what we call the neutral rate. It's essentially at what rate do we believe that the interest rate could get to before essentially inflation and the economy don't contract or don't expand, and that's what we call that neutral rate. So we think that inflation is probably more likely at this time, given where unemployment is, given where the markets are and the economies are still quite strong. That's probably closer to around 3% as opposed to 2. So that's been our base case for quite some time. So we think that it's probably more realistic at this point that inflation to get below 3% is going to be a bit of a challenge. The central banks still are talking about, particularly the Fed is still talking about this idea of 2%. So we'll wait and see as we go into 2024, but wouldn't be surprised if they do think that perhaps closer to 3% is more realistic given the current conditions. If you look at on the screen now, we can actually see the returns from the different asset classes. You can see there that we've basically showing there that global bonds, Australian bonds, cash. This is looking at year to date, and obviously, as I mentioned earlier, equities have run quite strong in the last, sort of 10, 12 months. And Australia there, a little bit slightly lower. Different drivers, obviously different economies. We have a smaller tech sector, for example, so that hasn't been a similar story. But we've still seen an Australian dollar that is below 70 cents to the US. And we've also seen quite still a strong price on our iron ore, which obviously helps our mining sector. But yeah, that's essentially the story. And cash, as we know, has performed quite strongly. We know what the reasons for that, but as we look at 2024, we wouldn't expect cash to continue to offer a similar strong return. I think the other thing to keep in mind, obviously, is the impact of inflation on all returns, and you might and we would expect that bonds, particularly Australian and global, will continue to be quite strong as we move into this period of interest rates being on pause or on hold. And then obviously, as I mentioned, we may be seeing some rate cuts in that second half of 24. This is an interesting chart because this really talks about, I suppose, the difference between we think about cash and we think about bonds or fixed income. So our bond funds, or when you invest in a bond fund or an ETF, Vanguard, we hold a whole bunch of bonds in that portfolio. And as each of those bonds matures, we get back our $100. We then reinvest that in a new bond. And often, or at least in the last sort of 12 to 18 months, we've seen that as one bond matures, we end up investing that or rolling that $100 into a new bond that's paying a higher level of income. So we have this almost this image of, if you imagine a term deposit matures, you then take that money and you invest it in another essentially another term deposit that's paying a higher level of income. This was what we call a coupon. So we hold our bonds to maturity, and then when they mature, we take that money and reinvest it at a higher coupon. So ultimately, what's been happening is the income that's being offered now by bonds has been higher, and as we reinvest in those bonds, the level of income from the whole portfolio has been rising. And essentially, that's why you want to be invested in bonds, is they don't typically perform or move in the same direction as shares, and you're wanting to receive that level of consistent level of income. Again, so looking at the year that was, so we're looking back here at 2022, and it was, we're comparing it to 2023, and as you can see there on screen, 2022 was an exceptional year. It's not unprecedented that bonds and shares move in the same direction at the same time. It does happen. For bonds and shares to move in the same direction, and what we call a positive correlation, which means they both move together. For it to fall essentially 10% for a year, it's happened around about 4 times in 100 years. When we look back at the research, so it wasn't unprecedented, but it wasn't a typical year. So we're very obviously very aware that 2022 was a tough year for those portfolios that were holding both stocks and bonds. But as we can see that for a correlation of bond stocks and bond returns, in something that was a 60-40 portfolio, that's shares and bonds, was a challenging year. But again, you can see from that dot on the screen in the tan color there that year to date, we've seen that this has moved more closely to what has happened previously. Each one of the green dots on screen represents 1 year, and you can see there that most of the time, stocks and bonds will typically, as a portfolio, will move in that positive direction. But the two red dots you can see there, 2022 and back into the period of the GFC, they're really outliers. So typically that doesn't really occur that often. When it does, you can see how it moves together. This chart's just looking at, again, this idea of bonds versus term deposits, so cash versus bonds. And what we're looking at here is essentially 30-year chart. And we're basically comparing the averages of each of those, of global bonds, of Australian bonds, and of cash. So each of those two, I guess, asset classes. Vanguard, we don't believe cash is an investment vehicle. Cash can be useful if you're wanting short-term access to money. Cash is useful or has been useful if you're wanting to simply take money out of bonds or out of the market and park it somewhere. But you don't want to leave it in a term deposit, for example. It's not a substitute or a replacement for bonds. And this chart originally bears that out. So when we look at the long-term average over this 30-year period, we can see there that the average return you would have received for cash was about 4.7 or 4.5%. But when you compare that to bonds, both global and Australian, you can see there that you're actually losing about over 2% per year over 30 years now. When you add that up, that's about a 60% difference between your total return from the start of that journey, I suppose, over the 30-year period. So it is something just worth reminding that when we talk about cash and we talk about the returns on cash versus bonds, that if it is seen as even in the short term, you may have seen that it looks like it's quite attractive, but in the longer term, you're actually losing out and losing quite a bit the longer we look at that time frame.
So you can just see on that chart there from sort of 2021 to 2023 that bonds have had a pretty wretched couple of years, obviously just being so low, interest rates basically getting down to almost zero. But now you kind of see that that's kind of flipped. And I think going forward, you'll start seeing a lot more sort of positive returns from being invested in bonds.
Absolutely, absolutely. So we saw this period of drag down or fall in the price of bonds, and that's typically what you would expect as interest rates rise. There's almost this inverse relationship between bonds and interest rates. So as interest rates rise, the price of those bonds falls. The market is looking for the next issue of bonds. So if a new issue is released, it's typically paying a higher level of income, and that's more attractive to an investor. So the investor will then jump into that, sell the existing. What we typically see looking at our research is that each time the interest rate hiking cycle, which we're in almost at the top of now, ends, you see that the price of those bonds then increases. So you get an improvement on the price of your bond, and also you're receiving that higher level of income. So this is what we saw over November, a very, very strong month for bonds. And this is what we would expect to see as we go into 2024.
Have you got an opinion on domestic bonds versus international?
The different characteristics. So if you're investing in terms of, if I take it back for a step, in terms of the types of bonds you can buy, for example, at Vanguard, we give you the opportunity to buy bonds that essentially are lending money to governments, lending money to corporates, lending essentially a mix of government and semi-government institutions. The average type of grade of credit in Australia is high. So once you start looking offshore, you're then increasing your diversification of the portfolio. You're investing with different types of companies, with different types of governments globally. So I suppose it's probably a question of diversification, and also with any exposure we have offshore is also hedged as well for any currency movements. So the idea of bonds is really keeping it, is having it in the portfolio. It's more of a ballast, I suppose, when you blend it with shares. But now I suppose it probably comes back to what are you wanting to achieve. For example, we do have a government bond ETF which invests in government, so it's issued here in bonds here in Australia, and so that's the volatility or the movement of those bond portfolios is quite low. The income is quite stable, and the risk is obviously not as high. So it really depends on what you're trying to achieve. But that's one of the great things of Vanguard is a lot of different products that can help you build the type of portfolio that you're after. Again, just looking at this one briefly. Again, this is really just telling the story again of the difference between investing in cash and investing in bonds. And so we see that most of the time, the longer you go out on this chart, you can see that that bonds outperform cash. Again, just reinforcing that point that cash is not it's not an investment vehicle per se, but it's also, if you are comparing the two and making a decision between one or the other, that staying in cash or investing cash over the longer term, it really does erode your total return. It's just not going to grow earnings or grow that money as much as bonds can. So again, this is looking at a 30-year chart, so it is taking that longer view, and it shows you that generally bonds will outperform cash longer than 1 year most of the time. So on screen now, what we've got is this is our what we call our Vanguard capital markets model. It's something that we use at Vanguard. It helps us make decisions around what's called our diversified index funds. And essentially, it's a model that helps us provide, I guess, a look forward or a bit of a projection on what we think markets are going to perform over the next 10 years. And what we can see here is essentially, I suppose, some of the takeaways is that the expected returns going forward essentially again a little bit more positive around the bonds as we've been talking about, and the reasons for that. Your growth assets that we talk about is your shares, or sometimes referred to as equities, can produce a range of outcomes, and the longer that column is, that means that the more outcomes that can occur. Obviously, we talk about the difference between bonds and shares are more volatile than bonds. So when you combine the two in a portfolio, you seem to see that there's less of that volatility, or a little bit more certainty of the outcome. So the returns we've got on screen give you more of an idea or a projection of how each of these asset classes will perform moving forward. And essentially, it really does call the key takeaway. Essentially, is that bonds are going to see a stronger performance in the next few years. And if you do include bonds into your portfolio, so shares and bonds combined, you should see that there will be I guess, less of a volatile return. So just a more smoother return, and giving you an expectation on screen of the types of returns you can expect on our modelling as we move forward. So we run this several times throughout the year, and each time it gives us a projection of what to expect looking forward.
Has that dropped in recent times, Brett? Like your average kind of return expectation?
The average return
expectation. History.
Yeah, exactly. So I think when we look at this, our expectation on global shares is probably dampened a little bit. We think that bonds are definitely going to perform better as we look forward into 24, but shares are probably not going to perform as strongly as they have historically. And you can see that in the returns there. That you can see for a portfolio that is 30% invested in bonds, 70% in shares on the far right of screen. We call our conservative portfolio. Has a pretty strong return, over 5.5% on a median expectation. When you compare that to almost the inverse of that, which is our high growth portfolio, you can see there, which is 10% in bonds and 90% in shares. You can see that that additional risk you're taking by investing in shares is rewarded, but probably not that highly rewarded. So again, we would say that yes, markets have run quite hard in the last few years, but we probably don't expect them to run as hard when we look forward the next sort of 5 to 10 years. So what I might turn to now is just looking at our 4 investment principles, and these principles have remained the same, have remained true since we were founded in 1975. And you can see on the screen there that the 4 principles are essentially setting your goals, having goals that essentially that you can when you create those, they obviously align to what you're wanting to achieve. You then want those goals to be measurable. So they're goals that essentially they're aligned to what you're wanting to achieve. They're measurable. You can understand, are you on course? And essentially they have that long-term outlook or focus. We then talk about balance. Balance is another way that I guess you could say diversification. So having a mix of assets in your portfolio, or having an index fund, for example, where you have a mix of companies in your portfolio. And we talk about this idea of being diversified, or making sure that you stay well balanced. Again, we can't predict what market's going to do tomorrow. So having a diversified or balanced portfolio, helps you manage those ups and downs of markets from year to year. We then talk about minimizing costs, and this is one that, as I mentioned at the top, was really a driving force behind the creation or the formation of Vanguard. And as Jack Bogle he really thought there was the managers were charging too much, and they weren't really thinking about serving the interests of the investors of their funds. So cost is crucial. Minimize the cost as much as possible, and if you are paying a fee or paying a cost somewhere, understand the value that you're receiving for that. So cost is crucial, and as Lee pointed out, we are bringing that average cost down here in Australia. We've brought that down obviously in the US over time, and we'll continue to do that, continue to represent you, our investors, and essentially our owners of our business. Fourth point there is really maintaining perspective. And again, this is really we refer to this term, we talk about stay the course, and that's really what that is. So, that noise that we hear, the media or the sound bites or the stories that are always talking to the negative, it's always important just to come back to, well, has anything changed? Do I need to really make a change to my investment plan or my portfolio? And again, this is why you have an advisor, and I've mentioned this many times about the importance of really just staying the course and thinking about the goals and objectives of your portfolio. Again, if we sort of dig into that then, and I've mentioned there you can see on screen, it's, goals, just, having clearly defined, measurable and attainable goals that are essentially adhered to and followed. Again, adhered to and followed essentially is, as you work with Lee, you'll develop these goals, you'll build the appropriate portfolios, and then it's essentially just staying the course. It's maintaining this focus on, just ignoring that noise and not jumping every time you see some a particular headline. So that's essentially what we talk about, and we do believe this at Vanguard. Again, this is a great image. This essentially is looking at, we talk about staying balanced or being diversified, and really this is just talking about that point of, if you look at markets over a long period of time, you're looking at, again, about a 30-year history. Each one of these images or icons is representing a particular asset class. And so you can see that when we look at this, we call this our quilt. So it's if you're looking at this screen, you may be trying to find a pattern in the screen or a pattern in this chart, but it's very difficult to choose or to know from year to year which is going to be the best performing asset class. There's no real discernible pattern, and you may have heard this term of a random walk, and it essentially is what it's saying, that cash was the best performing asset class in the year of 2022, last year. You can see cash now of where it sits on the table year to date. So I very much doubt that cash is going to be the best performing asset class when we reach the end of 2023. Again, you can see that it's very difficult to choose or to know what's going to happen year in, year out. Again, costs, we've touched on this, so it's essentially really keeping the costs as low as possible, and really this chart essentially tells that story over the longer term. And so we give a hypothetical example there of what would happen if you're paying a couple of percentage points more. You can see there a portfolio in red there with no cost at all. What your actual return would look like. You can see there that portfolio where you're paying essentially over a 1% return and then a 0.2% return, and it really does have an impact over the long term. And the longer that we obviously had this chart, we've lengthened the time horizon on this chart, and you can see the real impact that it erodes that total return for you. So that's quite a material impact on your savings, on your financial future. And then, as we said, number 4 there is really just maintaining that perspective. So I think this is a great chart. This is looking at global markets, and it's talking about this idea of trying to time markets. We talked about this idea of trying to time particular sectors within that kind of AI or tech space, but this is essentially telling you that if you try and time the market, you really do run the risk of missing out on some of the strongest performance days in market, which really does have an impact on that long-term investment success. So it's showing you the best and worst trading days have tended to essentially cluster together in very brief time periods. Often they can be on the same day or the next to each other, or one day apart. So this is showing you that 10 of the 20 best trading days, as measured by that MSCI World Price Index from January 1, 1980 through to December 31, 2022, occurred during years of negative total returns. So meanwhile, 11 of the 20 worst trading days occurred in years with positive total returns. So very, very difficult to to predict what's going to happen, and very, very difficult to time that those movements in and out of markets. Again, another way of looking at it is this. This is representing the S&P 500 index, and again, we're looking at a much longer period. So we went back and looked at, from 1928 through to 2021. Again, looking at what would happen if you missed some of the best trading days in the market. So this is actually your return of all of the trading days in the market, which is around about over 13,000. You can see there that you basically, there's really 30 of the best days account for most of the long-term return over that period of time. So staying out of the market can really reduce your total return. Trying to time it is almost impossible. So to put that into context, in Australia from 1972 to 22, the best trading days would result in about a 30% reduction in your total return as an Australian investor. So it's just something worth bearing in mind when you hear people talking about markets or trying to time markets, that staying invested is really the best chance you're giving yourself of making sure you hit those best days. So we talk about active versus passive, or we should say active versus index. The reason I mention that is because at Vanguard, there's a lot of work we do behind the scenes in managing an index fund, and there's a lot more to it. It looks quite simple on the outside, which is what we want, but there's a lot of work that goes into to obviously managing these portfolios. So then on screen you can see there is I mentioned earlier about this idea of core satellite. So we've been proponents of this core satellite solution for years, and essentially what we talk about core satellite is really just providing the benefit of a passive core, meaning that a fund that tracks an index, for example, the ASX 300, we keep the costs as low as possible in those portfolios by not constantly turning the portfolios over. We have the broad diversified portfolio, again, giving you that balance. It gives you access to thousands of securities across asset classes. Again, with that lower turnover of not constantly buying and selling shares, we're actually reducing those tax impacts on the portfolios, again, keeping those costs low. And that lower volatility is really due to us tracking those benchmarks. So we will make changes to the portfolios when there are changes to the benchmarks themselves, but essentially we're replicating and giving you that benchmark, tracking that benchmark and that exposure. When we talk about introducing active, it's really about bringing into a portfolio an active manager where it makes sense or where it's trying to achieve a particular purpose. So that will have to, that has to fit into your overall goals and objectives of what you're wanting to achieve. So we talk about this core and satellite, and essentially that's what we're talking about, is this idea of an index and an active fund or manager. Again, looking at some statistics on screen, we talk about this a lot in Vanguard, which is this. It's called the Aspiri report, and it's essentially Standard & Poor's indexing versus active report. It's been running now for over 20 years, and essentially you can see some numbers on screen there. But essentially, it's just comparing the two to say, well, when you are investing in an active manager, are they delivering for you above the market? You are paying more for that manager. So are they actually delivering you something that's in excess of the market return? So these you can see there on screen is that looking at some of those rates. So it's very difficult, and it's proven this, the longer the time frame, the more it's proven true that it's very difficult for an active manager to outperform essentially the market. And a big reason for that essentially is the cost. I mentioned the fee there. We looked at that chart earlier. So that headline fee is one key driver as to why it's difficult to outperform the market. Other reasons are including, again, trying to pick those individual stocks that are going to outperform, year in, year out. One year's winners could be next year's losers. And then just the additional costs within the portfolio, the cost of actually buying and selling those companies, the turnover, and also the tax implications that will again have a big impact on performance. So again, why we talk a lot about index and active, and also remembering that we have a very large active business in the United States and some of the global markets. So we're very, very aware of the fact that when we are trading, we also want to reduce cost as much as possible in our funds. So that is that's why we talk a lot about cost as well.
I think that's quite important, Brett. I've kind of gone through this with a couple of clients as well this year. So those numbers down the bottom, so basically saying over 5 to 10 year period, an index is going to outperform 80% of all active managers, right? So an active manager might have a particular strategy, a particular theme, and that might do well for, a couple of years, 5 years or whatever, but at some point their strategy might come unstuck. I think I've seen you guys done a bit of an analysis back, I think from say 2000 to up till now, where you've highlighted the top, 5 Australian equity managers. And then by the time it's 15 years later, they are nowhere to be seen. So because maybe their strategy has fallen apart or something's changed, etc. But this is the benefit, I guess, of using indexes is that, it has to buy all the stocks within that particular index. And as you mentioned before, last year's winners could be next year's losers and vice versa. So this is the benefit, I guess, of having a core component in your portfolio of using index funds.
Yeah, exactly right, Lee. And it's the longer you go, the longer you sort of go out on that time frame, as you say, of 10 years, 15 years, and 20 years, is that it's the level of skill required to outperform a market today is extreme. You also have to take into account how many of those investment teams will stay together, how many of those funds will actually survive, and the other thing to take into account is that when you actually then look at the after-tax return of these funds, the percentage of underperformance versus the market or their benchmark is in the 90s. It's almost 100% chance they're not going to outperform the market once you take into consideration the after-tax performance. So very, very difficult to outperform, and again, why we're such proponents of having a very strong index core as part of your portfolio, and it bears out year in, year out. It's as I said, it's over 20 years of research now, and the numbers speak for themselves. So I guess we couldn't have a presentation without having a Warren on screen. And Warren's he is a proponent for support of index funds. He did call that Jack Bogle, I think it was 2016, some Berkshire Hathaway AGM, where he did ask and asked Jack to stand, and he did give him a tribute. So I'll skip over this one, but there was the famous story is the $1 million bet that he made in 2007 prior to GFC, which ran to 2017, where he did take a bet with a hedge fund manager to say that the S&P 500 index would outperform the hedge funds over time, and he was proven true. And he ended up donating that $1 million to a local charity in his hometown, Omaha in Nebraska. So he is often quoted as being a strong proponent there of index funds. I've talked about core satellite. It is something that we are strong believers in, and I've kind of, I guess, spoken to these key areas. But again, always coming back to when you talk to Lee and you're looking at those portfolios, he'll talk about what is the best construction for that portfolio. And again, there's some resources that you can look at later, which talk to a lot of these key points. So with that, I know we're almost on time, but I'll open up to any questions.
If there's any questions, please pop them in the Q&A. But as we've mentioned this year, obviously we've sort of transitioned the portfolios to a more sort of core satellite approach to investing. And obviously some of the themes that Brett's touched on today, it sort of hits home to why we're using a fair bit of index funds within the portfolios. It's just, rather than trying to be so in on a particular theme or a particular strategy, we're just taking a lot more diversified approach to clients' portfolios. Brett, I've just got a question just in regards to, there's these biases that we have, and everyone's got a bias. The thought about investing domestically versus internationally, what is Vanguard's sort of approach to, you find maybe a lot of investors will just stick to what they know, and obviously here in Australia we're used to investing in the Australian stock market, but people kind of see investing globally is a bit too risky, right? What are your sort of thoughts or Vanguard's thoughts about investing, having more exposure probably globally than say domestically?
I think our view is probably borne out best in our diversified funds, and our diversified index funds do have, they do have an allocation to both Australian shares and global shares. I think if we remember that Australia, it does represent around 2% of the global investment market. So we are a small part of that global market. If we think about Australia per se, we have essentially a couple of key industries. When we think about mining, if we think about the financial, we think about the banking sector, we think about the key drivers of a lot of that return, or what we call skewness. So a lot of the exposure is really concentrated in, again, sort of a handful of stocks, I suppose, year in, year out. But our thinking is that you want to have a mixture of both Australian and global shares. You want to have a mixture of different types of markets. And as I mentioned earlier, having exposure to a global portfolio that includes to a large portion that US market gives you exposure to a lot of industries, a lot of companies that you can't get exposure to here in Australia. And it really does make sense to have a blend of both. In our diversified funds, for example, we do have exposure to developed markets. We have exposure to even emerging markets, and obviously here in Australia. And it tends to be, when we look at our research, we do tend to see that investors do tend to have, I guess, more of, you say, a bias, more of a home bias, but they tend to be more comfortable with, I guess, more local names. But that being said, we definitely think that you want to be diversified globally.
And yeah, on one of your slides, you had a sort of probably one of the outperformers was emerging markets. What's the rationale behind emerging markets doing sort of quite well over the next 10 years?
I think with emerging markets, it's probably been this idea of when we think about emerging markets, I suppose, and we think about the index, China makes up 30% of that index. Emerging markets, the growth there has been a little subdued more recently. China's probably, their growth typically was running at around 8% for many, many years. At the moment, its outlook is probably closer to 5.5. There is opportunity there for obviously future growth in that particular market. There's also a lot of opportunity in some of these growing markets. For example, if I think about India as an emerging market, that is still very much has got a long runway in front of it in terms of the growth there. And I think that the US dollar obviously has a big impact on these emerging markets and how their markets are priced. So there was a bit of a drawdown in some of these markets over, we think about 2022 into 23, but it does offer the opportunity then of probably a stronger return when we compare it against markets like the US in the last year or so. So there's some good opportunities there, and I think there's a lot of I don't think you want a portfolio that I suppose that totally removes exposure to those markets. But in our diversified funds, which is I guess suppose our best thinking, we do have exposure of somewhere between sort of 1 to 3% across the portfolios in emerging markets.
Okay, well, looks like there's no other questions. Brett, thank you very much for your time today. That was a very, very informative presentation. Thank you again for putting this together. And I know obviously it's close to Christmas and we're all kind of a bit tired towards the end of the year, but mate, much appreciated. And I thank you very much for joining us today.
Thank you. And look, again, obviously wish you all of your clients a great Christmas and a great break through the holidays. And again, on behalf of Vanguard, thank you for your trust and your support and in your investment.
Appreciate it. Thank you, everyone.